Hello everyone, and welcome to UBS Trending. I'm Steve Mattis, Head of Advisory and Planning Products. Thanks for joining us. As you know, tax season is nearly in full swing, with individual returns due on April 18th. Each year, the Advanced Planning Group here at UBS releases their much-anticipated tax planning guide. To talk about this year's edition, I'm joined by its author, Brad Dillon, Senior Wealth Strategist. Additionally, we wanted to leverage wealth management's valuable partnership with our Chief Investment Office, so we've invited Dan Scansaroli, Head of Portfolio Strategy and UBS Wealthway Solutions from the CIO team to discuss how clients can manage their taxes, not just at tax time, but throughout the year. Brad and Dan, thank you for joining me today on this segment of UBS Trending. Brad, let's jump right in. Can you give us a little more information on this year's tax guide from the Advanced Planning Group, including what it is, where to find it, and what are some of the highlights or surprises from this year's guide that you think people should know about?
Sure. Thanks, Steve, and thanks for everyone tuning in. The tax planning guide is really just an overview of relevant tax laws that apply to ultra high net worth individuals and their families. So it's a timely overview. The Advanced Planning Group where I sit, which consists of a bunch of formerly practicing attorneys, we all put this guide together on an annual basis to update our clients and our advisors on the relevant tax landscape and how that's changed over the course of time over the last year. And so clients can find this. It's buried in it are lots of little nuggets for tax management, tax minimization strategies that clients can use with their other tax advisors and professionals to think about which strategies might apply to them. And so you can find this guide just by reaching out to your UBS financial advisor. I want to talk about a surprise and a highlight. The first is surprise. If you had talked to any of us last year, or any tax professionals last year and surveyed us, you might have recognized that most of us would have thought that we were in for some significant tax changes given the landscape last year, and we'll talk about that. But it's to set the stage for a moment. What happened last year was, at this time last year, President Biden had just been sworn into the Oval Office. The Democrats had just narrowly secured victory in the Senate, and this was all in the backdrop of President Biden's campaign proposals to raise taxes on corporations and the wealthy. And so we really spent the bulk of last year under the specter of seemingly inevitable tax changes. And in fact, in May of last year, President Biden released his Green Book proposals, his sort of wish list of tax proposals. Then in September, the House released their draft bill, which contains sweeping proposals and overhauls to the tax regime. And then they pared down that bill, sent it to the Senate late last year where it effectively died. And here we are well into 2022, and there are no significant changes that were codified from any of those proposals last year. And so that's the biggest surprise out of this year's guide, is that there aren't that many surprises. That might be good or bad, depending on how the tax laws apply to you, but that's the big surprise. It doesn't mean, however, of course, that tax laws might not still change this year. After the State of the Union, our UBS Office of Public Policy made a statement that said that tax increases should still be considered on the table this year in Congress. So that's something to watch out for. We'll be watching out for that, of course, and following up as any developments do occur. So that's a surprise, or maybe a non-surprise, depending on how you look at it. But one thing I want to highlight are the effects of inflation, right? That's inflation's a lot of it's on our minds lately, and of course it ticked up sizably by the end of late last year, and that had a positive tailwind effect on a lot of the figures in this year's guide and throughout the entire Internal Revenue Code. And so one of the ways that we can see this, or an example we might see how it has a positive effect for some of our clients after tax wealth, is just in the marginal rates in the brackets. The highest marginal rate of 37%, for example, applies to a married couple with more than $628,000 last year. This year it's $648,000. So that increase of $20,000 provides a nice tailwind for clients. Also in places where the inflation adjustments can have a positive effect for our clients and their after-tax wealth. The standard deduction was increased by $800 for a married couple to $25,900. The gift tax annual exclusion amount increased to $16,000, up from $15,000 where it had remained for several years. The gift and estate tax exemption amount increased by whopping $360,000, all the way up to $12,060,000 last year. So a lot of positive tailwinds from inflation. However, all that glitters is of course not gold. Inflation adjustments aren't tied to most of the figures in the guide or throughout the Internal Revenue Code, and that can actually have a really deleterious effect on our clients' after-tax wealth. One example of that are for homeowners. If you go and sell a home, the tax code provides this really nice benefit for homeowners that says that the first $250,000 of the sale of that home is going to be gain-free, $500,000 for a married couple. Well, those $250,000 and $500,000 amounts have remained unchanged in the tax code since 1997. That's 25 years where we haven't seen an increase in those figures. So as inflation rises, the benefits of that exclusion from the sale of a home decrease. And you see this throughout the code. There are a couple of other places I mentioned, although there are many. One is the $3,000 limitation on the deductibility of capital losses against ordinary income. That's been around for eons unchanged. Another place is the application for the threshold of the net investment income tax, that additional 3.8% tax. That has remained unchanged since it was enacted in 2010. So the effect of inflation, as inflation rises, that new tax actually effectively applies to more and more people as inflation continues to rise. So there are a few places there. It might be a wash for taxpayers, it might be a benefit, it might be a loss, and we work with your tax advisor, but this tax guide is really a place to look at where those figures might affect you.
Very, very helpful. Thanks, Brad. I want to turn now to Dan Scansaroli for a moment to put some of this into context for us. Dan, how does CIO think about tax management as it relates to investing for our ultra-high net worth client segment?
Yes, thanks, Steve. First I want to start off by talking about the fact that we're talking about tax management, not tax minimization when we talk about investing. We don't want the tax tail to wag the investment dog at the end of the day. By trying to minimize your taxes, you often miss out on large opportunities to maximize your after-tax wealth, even if you're getting a tax bill out of it. And so, generally the way in which we think on CIO is that there are three considerations throughout the year and three strategies that you should take to manage those taxes. And the first is to look to evaluate your asset allocation and make sure that you have a well-diversified portfolio. Diversification does a lot more than just reduce and manage volatility. It actually allows you to net capital gains against losses as certain assets zig and other assets in your portfolio zag. And by systematically rebalancing your portfolio, particularly during times of high volatility, this can allow you to mitigate that tax drag and have more assets in your portfolio to grow. The second strategy that we look to evaluate is the tax efficiency of the vehicles they have in your portfolio. So ETFs and separately managed accounts, known as SMAs, they give you a lot more control over when you realize your taxes. And this can be worked to your advantage in terms of making sure that you're maximizing long-term capital gains instead of those short-term capital gains, which are taxed at ordinary income, which is significantly higher. This is not to say that you should avoid high turnover strategies that may be able to outperform that tax drag or that additional tax bill. But when we think about the tax efficiency of our vehicles, we may want to actually consider taking those higher turnover, higher tax vehicles like actively managed mutual funds, hedge funds, or even high income funds, and putting them in tax deferred accounts where they don't have that same impact. And the third strategy that you should consider is maximizing the use of tax advantage accounts and trusts. For your immediate and your long-term needs, your last resort should be to put excess savings into your brokerage account, which is fully taxable. You should look first to your 401k and maximize contributions there. Then looking down our savings waterfall, which we're showing here, think about your health savings account. In the retirement years, we know as we get older, we have ever increasing healthcare costs where we can take advantage of healthcare savings accounts and grow those assets over time on a tax deferred basis. The same is true if you have a child or grandchild who you're planning to send to college. Use a 529 college savings plan to start growing them. Each one of these allows you to grow your assets on a tax deferred basis and therefore manage your taxes more efficiently and end up with more wealth over the long term. It also makes you more resilient when we go through those times that you mentioned, Brad, yep, where we're talking about changes to the tax code. The tax code never hits all of these different types of accounts at the same time. The last thing that I'd like to mention is relative to trust and the benefit of others. For the assets that you have that you know that you're not going to need immediately, that you really want to leave an impact on the world, gift now instead of later. And so, you should look to maximize gifting now, because by delaying gifting, those assets are going to continue to grow in your estate and eat up the gift tax exemption that Brad mentioned. And it's even more pertinent now because that gift tax exemption is actually scheduled to sunset if Congress doesn't act by 2025, and it will be essentially cut in half. So this is a really big missed opportunity to not get those assets out of your estate now, where they can grow, on an after-tax basis.
A really important call to action for many of our clients. Thanks, Dan. With just a couple minutes remaining, I'd like to ask each of you what key action or actions clients should consider taking right now. Brad, let's start with you.
Great. So I have three quick ones. Prior year IRA contributions. So even though it's 2022, you may be able to contribute to an IRA this year to offset your income from 2021. If you didn't maximize your contribution last year, it's not necessarily too late. You may have until April 18th of this year to do that. Number two, Roth conversions. Given the effect of the macro environment right now in the market, it might be a good time to discuss with your tax professionals, your UBS advisor, whether it's a good time to convert some of your retirement accounts into Roth accounts. Both types of accounts do grow income tax-free. However, only Roth accounts do provide that nice tax-free distributions during retirement, or that possibility. The trade-off, of course, is that the converted amount, there might be income tax on that. So something to watch out for. And again, it would make sense to work with your UBS financial advisor and other tax professionals here. Number three, to just reiterate what Dan was saying, because it's so important, the gift and estate tax exemption amount, estate planning, that exemption amount has increased to $12,060,000, as I mentioned, more than $24 million for a married couple. That's the highest it's ever been in history. And as Dan mentioned, it's going to be cut in half approximately at the end of 2025. So now is really the time to be working with your UBS financial advisor, working with my team, the advanced planning team, to get your estate planning in order, because our mantra is planning early is always better than planning later. It's almost always more tax efficient to do so.
Great advice. Thanks, Brad. Yeah. Dan?
Well, borrowing is often an overlooked strategy that you can use to manage taxes and keep you invested, particularly when you have liquidity needs. So particularly with the season that we're in, with April 18th coming up, use borrowing to pay for your taxes instead of liquidating your portfolio. This can be particularly powerful if you're sitting on large capital gains, as so many are after the rally that we've had in markets over the last 2 years. Where if you're going to sell those assets, you're going to generate another future tax bill that could be avoided. Rates are still at near historic lows, despite the fact that they have been rising. And that's a low hurdle rate to keep your money invested that most likely it would likely outperform. And that will ultimately benefit you in more than one way, because it will help you avoid realizing the taxes on it. But you also may be able to get a benefit to be able to write off the loan costs on your ordinary income. And that ultimately means that you have more money in your account growing instead of liquidating that outside your account and refilling it later.
Great idea. And as you said, rates have been rising. They pulled back a bit this week, but we think that the trend is that they will continue. But still a good time to borrow in advance of April 18th, if that makes sense for your clients. So thanks, Dan, Brad, for joining us today. And thank you all for watching. For more information, please visit ubs.com/views. And make sure to follow UBS on social media, LinkedIn, Facebook, Instagram, and Twitter. You can also find past UBS Trending episodes on demand on our website, ubs.com/studios. As always, if you have any questions about your portfolio, please speak with a financial advisor. Until next time, I'm Steve Mattis. Have a great day, and remember to keep your eyes on what's trending.